Welcome to the deep dive.
Okay, so you've brought us some interesting material today, all focused on Richtech Robotics, ticker RRR.
That's right. Yeah, they're one of those companies popping up as AI and, automation really start changing things for businesses.
Definitely seeing that. And it feels like robotics, actual physical robots, are a huge part of that.
Oh, absolutely. The need for robots that solve real problems, think labor shortages, efficiency boosts, it's just massive right now.
Yeah.
And companies like Richtech, the ones actually building them.
They're right in the middle of it.
Exactly.
And your sources suggest Richtech has really gained some attention lately.
Yeah, they've hit a few radars. The main catalyst, the big thing flagged in the material you have, is this preliminary inclusion in the Russell 2000 index.
Ah, okay. That's often a pretty good deal for smaller companies, right?
It can be a major inflection point, yeah, especially for a small cap like this one.
Got it. So our mission here is to really unpack these sources you've given us. We want to get a handle on why this stock is getting noticed now.
And look at both sides, the potential the sources see, but also the risks, because they seem pretty significant too.
Definitely a story with some sharp contrasts. It's not straightforward.
No, it really isn't. Because you look at the stock performance mentioned up over 240% in just 6 months, which is huge.
A remarkable run, yeah.
But then the sources also dive into some financial details that, well, they definitely raise some questions, make you pause a bit. Okay, so let's dig in, starting with that catalyst, the index inclusion. June 27th, 2025, you said.
That's the date, yeah. Set for inclusion in the Russell 2008.
So just briefly, why is that specific index, that specific date, such a big deal? What does it do for a company like Richtech?
Well, think about the scale. The Russell 2000 is tracked by funds managing. I think the number is around $10.6 trillion in assets.
Wow, okay.
So when a stock joins, all those passive index funds, they have to buy shares to match the index.
Yeah.
It's automatic buying pressure.
Or forced buying.
Yeah. Exactly. And beyond that, it just massively boosts their visibility. Suddenly, active managers, institutional investors who benchmark against the Russell. They're looking at it. It puts them on a much bigger stage.
Kicks them from the small leagues to the majors, in a way.
Sort of, yeah. A much bigger pond, definitely.
And the market's already reacted. Your sources mention the stock movement.
Oh, yeah. The sources are clear. The stock's been trending up strongly. Very volatile, mind you, but the trend is up. Over 240% in 6 months, like you said, and over 120% in the last year.
That kind of momentum, yeah, it definitely gets noticed.
You can't ignore it.
Okay, so let's unpack the bull case then, based only on what's in your material. Why the optimism? What's driving that run, according to the sources?
Well, the first big thing they hammer home is that Richtech has real products. This isn't just, some concept on a slide deck.
Right.
They mention specific robots already out there working. Metro D for restaurant deliveries, Medbot for hospital logistics, Titan for warehouses. They're deployed.
So targeting industries with, known pain points.
Yeah.
Labor shortages, efficiency needs.
Exactly, solving actual problems today. And then there's the pivot they're making, which the sources see as potentially huge.
Okay.
The shift to a robot as a service model.
RAAS, okay, like SaaS, software as a service, but for robots.
Pretty much. The sources describe it like a mix SaaS principles, but also hardware leasing plus ongoing service and support subscriptions.
So moving away from big one-off sales.
That's the goal. Shift to predictable recurring revenue, make the robots more accessible, lower the upfront costs for businesses via subscription.
Which could speed up adoption, maybe?
That's the theory. Improve scalability. One source even made a comparison to how Salesforce changed enterprise software with subscriptions.
That's a bold comparison. They
Yeah.
pull that off.
Big if. But yeah, that's the bull argument.
What else supports that optimistic view in the sources?
Their whole operational setup gets mentioned, this vertically integrated model.
Meaning they do everything themselves?
Yeah. Basically, yeah. Design, manufacturing, software development, it's all in-house.
And why is that seen as a plus, especially for this Raise S thing?
Well, the sources suggest it lets them iterate faster on the robots, tweak them quicker.
Makes sense.
It allows for more customization for specific clients and maybe gives them tighter cost control versus relying on outside suppliers.
Right. If you're providing a service, controlling the hardware and software integration seems pretty key.
Crucial for quality and support, you'd think.
Okay. And are they scaling up? Mention of expansion.
Oh, big time. A key point highlighted is a new facility. It's apparently boosted their manufacturing capacity by something like 400%.
400%, wow.
Yeah, a huge jump. You need that kind of capacity if you're serious about bigger Reyes rollouts or landing larger contracts. They even mentioned potential international deals are being discussed.
Okay, so the ambition is there, the capacity is scaling. Any other positive signals flagged?
Yeah, a few things. International pilots are apparently running and they're making strategic hires, AI, sales, software people.
Building the team.
Right. Their CES 2025 showcase apparently got good buzz. And the sources mention a specific analyst rating too. Lake Street Capital put out a buy with a $3 price target.
So at least one firm is publicly bullish based on this material.
Seems so. And this all plays into that wider context, right? The whole automation boom.
Yeah, you hear about it constantly.
Enterprises everywhere are feeling the pressure cut, labor costs, boost efficiency. It creates this underlying demand. Your sources even dropped that quote from NVIDIA's CEO, Jensen Huang.
Oh, yeah?
The robotics era is just around the corner. Adds a bit of, sector weight.
It definitely frames the opportunity. Okay, so summing up the bull case from these sources. Not vaporware,
Mm-hmm.
real robots working now.
Mm-hmm.
Scaling up manufacturing, hiring talent, pivoting to this RAS model they hope is scalable.
Right.
All happening in a potentially massive market. And if they execute on RAS, the suggestion is the current price might look cheap later.
That's the essence of the optimistic take presented in the material, yeah.
Okay, that paints a compelling picture. Potential, opportunity. But these sources, they don't stop there. They lay out a pretty significant bear case, too. Reasons for caution.
Mm-hmm. And this is where the financials detailed in the sources really come into play. And frankly, they're concerning.
How so? What's the main worry?
The big one is falling revenue.
Falling. But they're deploying robots, pivoting. How much is it falling?
The sources cite trailing 12-month revenue, so the last year at $4.39 million. And the really stark number is that's a 51.6% decline compared to the year before.
Whoa. Over 50% drop year over year. That's
steep.
It's a major red flag.
How do they explain that, according to the sources? Does management address it?
They do. The sources say management pins it mostly on that RAS transition.
Okay.
The argument being, they're swapping big upfront payments for smaller recurring subscription fees spread out over time, so revenue looks lower now.
But that's a temporary hit they expect to recover from. That's the hope. But the sources immediately flag the execution risk. It's huge. They haven't actually proven yet that this Reyes model will bring in enough recurring cash to make up for the lost sales and turn that revenue trend around.
So it's a strategic gamble with immediate financial pain.
Exactly. A bet that hasn't paid off yet on the top line.
Right. What about the bottom line? Profits? Cash flow?
Well, that's the other part. The sources point to mounting losses. A net loss of $12.36 million reported.
Ouch.
Which works out to an EPS earnings per share of negative $0.14, losing 14 cents per share, and negative free cash flow, too.
Meaning they're burning through cash faster than they're bringing it in.
Precisely, spending more than they generate from operations and investments.
Okay, so losing money, burning cash.
Right.
Does that raise funding concerns in the sources? Like, can they keep the lights on and fund this expansion?
It definitely raises the question. The sources mention a lack of sort of detailed info on their cash reserves in recent filings, which suggests they might need to raise more money fairly soon. And if they do that by selling more stock,
existing shareholders get diluted. Their slice of the pie gets smaller.
that's the risk. Yeah. Dilution.
Any other warning signs the sources picked up on?
Yeah, they mention insiders selling about $856,000 worth of stock sold by insiders over the last 12 months.
Okay. Is that a lot? How is it framed?
It's not necessarily a disaster signal on its own, but the sources suggest it could hint at some internal caution, especially when you see it happening while the stock price has been soaring.
Ah, that contrast. Price rockets up, some
Yeah.
insiders sell. Yeah, that's worth noting.
It is.
What about the big investors, institutions? Are they buying into this story? Beyond just the index funds that have to.
That's another point of caution raised. Weak institutional ownership.
Still, even with the Russell inclusion coming.
Yeah, even with that news out there. Currently, only about 5% of the shares are held by large institutions, according to the sources.
Oh, that's low.
It is low, and it implies that a lot of the big, sophisticated money managers are still skeptical, or at least waiting on the sidelines, not yet convinced by the turnaround story or the financials.
So the index inclusion forces some buying, but it hasn't triggered a flood of organic institutional interest yet.
Seems that way based on the numbers presented.
Okay. And competition. Are they alone in this space?
Oh, definitely not. The sources name names. Bear Robotics mentioned with a $500 million valuation.
Right.
Purdue Robotics described as active globally. And Nightscope, which is a public peer, market cap around $150 million.
So established players, venture-backed players, it's a crowded field.
Very much so. And the sources use these examples to really underline the competitive pressure. Building robots is expensive. It's capital intensive. And you've got serious competition on price, on features. It makes just getting to profitability that much harder.
Okay, let's try and sum up that bear case from the sources then. You've got revenue that's falling sharply, like over 50%.
Yeah.
Big mounting losses, burning cash, which raises funding and potential dilution worries. Some insiders selling against a rising price. Very low institutional buy-in despite the index news, and tough competition in an expensive market.
That covers the main points, yeah. The sources really frame it as high risk, high reward at this moment.
Right.
They basically say Richtech has to prove this RAS model works. They need to show that recurring revenue growing predictably and show a clear path to closing that loss gap.
Otherwise,
Otherwise, it remains a speculative bet. That's the take from the material. Success hinges entirely on executing this transition.
so pulling it all together from these sources, it really sounds like a company at a genuine pivot point, a crossroads.
Absolutely.
On one side, you've got this exciting potential, real robots, real problems being solved. They're scaling up capacity, making this strategic RAS shift.
Plus the tailwind of the whole automation trend, and now this index inclusion forcing some attention.
Right. But then on the other side, these immediate, very real financial hurdles. That revenue drop is jarring.
It is. Falling revenue, big losses, cash burn, the funding question mark, and strong competition breathing down their neck.
It feels like the potential upside the sources describe is real, but the risks and the financial challenges are maybe more immediate, more tangible right now based on those numbers.
Yeah. I think that's a fair summary of the tension in the sources. The narrative, the story is powerful.
Yeah.
But the current financial reality, it's tough. It all comes down to execution.
Yeah. And getting a handle on companies like this, understanding both that exciting story and the hard numbers laid out in the sources, that's so crucial if you're trying to stay informed in these really fast-moving tech sectors. Your sources really hammer home that the next 6 to 12 months feel critical for Richtech. They need to show this RIAS thing is working, show a path to sustainable growth.
They need to turn that vision into actual financial results. Validation is key now.
Which leaves a final thought, really, for you, the listener, as you look over these sources yourself. Is this RAS model the engine Richtech needs? Is it truly scalable? And can they execute it fast enough to get past these financial hurdles? Or does that execution risk, trying to pull off such a big shift while facing losses in competition, make the current challenges just too significant? Something to really mull over as you dig into the details.